Okay, let's unpack this one. Imagine a company, right? PE ratio hovering around 5 and a dividend yield that's pushing almost 15%. Sounds like an investor's dream, doesn't it? Like a true value proposition just screaming for attention. Today, we're doing a deep dive into Vale. That's the colossal Brazilian mining giant trading on the New York Stock Exchange, ticker VALE. We've got a stack of sources here, and they paint a really fascinating, complex, and, well, sometimes challenging picture of this company. So our mission today is to really dissect what makes VALE so intriguing, try to uncover the hidden catches, and, ultimately help you understand its true potential and its real risks within this dynamic global economy.
Indeed. And what immediately grabs your attention, I think, and what our sources highlight right from the start, is that initial glance at Vale's core numbers. You see a price, $9.17 per share. You couple that with that incredibly low PE and that, well, frankly, eye-popping dividend yield. It's certainly designed to make investors pause and take notice.
Yeah, definitely makes you look twice.
But, as we often find, right, especially in the world of commodities, these industrial giants, understanding the why behind these numbers and looking far beyond the immediate headlines, that's absolutely crucial. This isn't just about, spotting an undervalued gem, maybe. It's about uncovering the much bigger, more intricate story that lies beneath the surface. And that's precisely what we're aiming to do for you today.
Right. So let's dive right into what first caught our attention. Those really impressive numbers that just jump out from the data. They hint at significant shareholder returns. When we crunch the figures from our sources, VAL has paid out a total of $6.83 per share in dividends. That's over the last 5 years. Now, if you take that average annual payout, derived from that 5-year total, and compare it to today's share price, that $9.17, you land at an annual yield of approximately 14.9%. Think about that for a second. Nearly 15% annual yield from a company of this scale. That's a figure that certainly makes you do a serious double take in, well, today's market environment.
Absolutely. A yield like that is quite rare.
But here's where it gets really interesting, I think, and perhaps even more indicative of maybe management's commitment to shareholder value. This company hasn't just been, content with those robust dividend payouts. They've also been aggressively buying back their own shares right from the open market, significantly reducing the total number of shares available. We're talking about a massive reduction. Their share count is down almost 20% since 2020.
20%? Wow.
Yeah, specifically from about 5.13 billion down to roughly 4.27 billion shares outstanding today.
That combination, right? Consistently high dividends and such significant sustained share buybacks. That's pretty rare to see from a company, isn't it? Especially when in a capital-intensive industry like mining. It suggests a profound commitment maybe to returning capital, enhancing per-share value, but also perhaps signals some underlying confidence for management. Absolutely. The impact of such a substantial reduction in share count is profound. For any company, really. But it's particularly potent for one operating within a highly cyclical industry like commodities. When the company reduces its outstanding shares like that, it just means that any future returns to shareholders, whether those come through continuing dividends or further buybacks, they're now spread across a much smaller base of shares.
Right.
Which inherently magnifies the per-share value for existing investors. It's a powerful way, often overlooked actually, to boost shareholder wealth without necessarily increasing the total amount of capital being returned. You're essentially concentrating the economic pie into fewer slices.
Makes sense.
And to connect this to the bigger picture, right?
Yeah.
To really illustrate the potential upside, let's consider 2021. That was a particularly strong year for iron ore prices. You had post-pandemic stimulus, robust demand.
Yeah, iron prices went crazy then.
They did. And in that year, Vale returned over $18.3 billion to shareholders. It was a remarkable combination. $5.2 billion came through aggressive share buybacks, and a hefty $13.1 billion was distributed as dividends.
Wow.
Now imagine, just for a moment, if iron ore prices were to revert to those higher levels today, but with the significantly reduced share count we just discussed, that 4.27 billion shares outstanding, that same $18.3 billion in total shareholder returns, when you divide it by the current share count, it could potentially translate to a staggering $4.29 per share.
$4.29 per share.
Potentially. And based on today's stock price of $9.17, that's a hypothetical annual yield of, get this, 46.7%.
46%.
Hypothetical, of course. This isn't a prediction, let's be clear. But it's a powerful illustration, isn't it? It shows the immense leverage and upside that a reduced share count can provide in a strong market environment. It really highlights the potential for truly exceptional returns if the commodity cycle turns favorably.
That's incredible leverage.
And it's not just about the dividends or the, immediate potential returns in a booming market. When we examine VLE's historical profitability, the data is, well, it's striking. Their total earnings per share over the last 5 years aggregated to $13.21.
1321 over 5 years.
Exactly. Think about that. That's significantly more than today's stock price of around $9.17. This isn't just a cheap stock by current metrics, you see. It's a company with a proven, robust profit engine. Historically, it has generated substantial earnings. This suggests a deep history of strong underlying profitability that could, and very well might, recur as commodity cycles inevitably turn. This historical earnings power offers a pretty compelling argument, I think, for the company's intrinsic value. It extends far beyond just the current share price and dividend yield. It indicates a substantial underlying value just sort of waiting for the right market conditions to manifest.
Okay, that historical profitability and potential upside are definitely compelling, but let's unpack this further. Where does all this money, all this incredible potential actually come from?
It's abundantly clear from our stack of sources here that Vale is overwhelmingly an iron ore miner.
Predominantly, yes.
Approximately 82% of their revenue comes directly from iron ore. Nickel contributes a smaller but still significant 12%, and copper makes up around 6%. This is pretty concentrated, isn't it, in one key commodity. Its fate is largely tied to, well, global demand for steel.
Exactly right.
So what does this dominant position in iron ore mean for you as someone looking at this company? It means Vale's fortunes, and therefore the stock's performance, its ability to generate those impressive returns we just talked about. They're incredibly, almost directly tied to the global price of iron ore.
Very tightly correlated. The experts we consulted, they emphasize Vale is highly cyclical. And perhaps more importantly, your entry point as an investor matters profoundly for generating strong returns. We saw a dramatic spike in iron ore prices, following the reopening after the initial COVID shutdowns. Prices soared to extraordinary highs. It clearly illustrated this direct, almost one-to-one connection. Commodity price, Vale's performance. Conversely, when iron ore prices retreat, Vale's profitability feels that impact acutely.
It really does. And what's truly fascinating here, and something our sources really underscore, is precisely how sensitive Vale's free cash flow yields are, even to relatively small fluctuations in iron ore prices.
Right.
This isn't like a straight line relationship. It's almost exponential in its impact.
Yeah.
For example, right, if iron ore prices are hovering around, say, $95 per ton, which we've seen recently, you might expect Vale to generate maybe an 8% free cash flow yield.
Okay, 8%.
But if those prices experience even a modest drop, let's say to $80 per ton, that yield plummets significantly, down to just 3%.
Wow, from 8 to 3, just from a $15 drop.
Exactly. Think about the implications of that swing, right? On a company's ability to pay dividends, repurchase shares, reinvest. But on the flip side, if prices climb above $100 per ton, which has happened often enough in the past, we're talking about a remarkable 20% free cash flow yield.
20%.
This incredible sensitivity to the underlying commodity price just clearly underscores how critical the iron ore market is to Vale's financial health, and by extension, of course, to its shareholder returns. It really highlights the inherent leverage within their business model.
That sensitivity is key then.
Absolutely. And stepping back for a moment, connecting this to the broader global economic picture, China. China is unequivocally the most important geography for Vale. It accounts for a massive 70–80% of global iron ore imports.
70 to 80%.
Making it the undisputed driving force behind demand. Therefore, the ongoing struggles we're seeing in China's property and infrastructure sectors.
Yeah.
That's not just headline news for global macro folks. It's directly impacting demand for iron ore, and consequently, Vale's revenue and profitability.
Right, you see developers like Evergrande, Country Garden, major crises.
Precisely. Major financial crises, defaults, halted projects. This directly translates to reduced demand for steel and thus for the iron ore that Vale mines. So a real and sustained recovery in Vale's fundamentals is, without doubt, highly likely tied to strong, decisive, consistent stimulus from the Chinese government. Stimulus aimed at revitalizing their construction sector, broader economic activity, the duration, the efficacy of that stimulus. Those remain key variables for Vale's outlook.
That makes perfect sense. So China's economic health is absolutely paramount. But despite this cyclical nature, this heavy dependence on a single market, our sources point to a critical competitive advantage Vale holds. What allows them to sort of weather these storms?
That's a crucial point. Despite this inherent cyclicality, this dependence on China, Vale possesses a significant competitive advantage. They are consistently one of the very lowest cost producers of iron ore globally.
Lowest cost, okay.
Much like their big Australian counterparts, BHP, Rio Tinto, VLE operates with impressive economies of scale, efficiency. This contrasts sharply with many Chinese iron ore producers who operate at much higher costs.
So why is that?
Well, primarily it's due to lower quality domestic ore in China. It requires more intensive, more costly processing, and also higher domestic transport expenses. Their mines are often located far from the major steel mills. So this means VLE can remain profitable and, crucially, cash flow positive, even when iron ore prices fall to levels that would make the vast majority of Chinese operations unprofitable, like, for example, around $80 a ton.
Right.
This low-cost position provides a substantial margin of safety during market downturns, and it gives them a significant edge in global competition. It's a huge structural advantage.
So they have a buffer.
They do, and delving into their operational details, it's clear they're not just passively waiting for prices to recover. VLE is actively working to improve their production capabilities and enhance product quality. It demonstrates a long-term strategic vision. We're seeing concrete plans, for instance, to increase iron ore output from about 328 million tons per year currently, up to a target of 360 million tons.
More volume.
But it's not just about volume, it's also about quality. They are focusing intently on increasing the average iron ore content of their product. Currently, their average iron content is around 62.5%. They aim to push that to 63%, maybe 64% by 2030. The higher the iron ore content, the better the price they can command.
Ah, okay, the premium.
Exactly. It directly translates to improved margins, even in a lower price environment. It's a subtle but powerful way to enhance profitability. Furthermore, and this is a key part of their longer-term strategy, they are strategically diversifying into other critical minerals. While copper currently accounts for only, 6% of their revenue, their copper production is set for a significant increase, projected to go from about 345,000 tons in 2024 up to an impressive 460,000 tons by 2030.
That's a big jump in copper.
It is. And VAA is already a major player in nickel, ranking as one of the top 1 to 3 producers globally. So this growth in copper and nickel, while still smaller segments compared to iron ore, it's substantial, and it aligns directly with the burgeoning global energy transition demands.
Yeah.
EVs, battery storage, renewable energy infrastructure.
Right, those need copper and nickel.
Exactly. This demonstrates a forward-looking strategy, I think, recognizing the changing landscape of global material demand.
That strategic diversification is certainly a positive long-term signal. Makes sense. But let's talk about something that's, well, a bit of a puzzle from the sources. Vale's inventory levels. They've been decreasing over recent quarters. What exactly does that signify for the company and for us as listeners trying to understand its true position?
That's an excellent point, and it raises a critical question for interpretation. Definitely. We do see VLE's inventory decreasing over recent quarters, and the why behind it is absolutely crucial for understanding its impact on prices, on the stock. On one hand, right, falling inventory could be a very positive sign, particularly if it's primarily due to exceptionally strong demand, meaning Vale is successfully selling more iron ore than it produces.
Okay, that would be bullish.
That'll be a clear bullish signal for the company, definitely. Yeah. However, it could also signal production issues,
right?
Maybe unexpected maintenance at mines, processing plants, or even regulatory factors impacting operations somehow. In that scenario, it's more neutral, maybe slightly negative, as it limits their ability to capitalize on demand. More concerningly, though, a decline in inventory could reflect a deliberate cut in anticipation of slowing demand. For instance, if they foresee a deeper downturn in China's struggling property sector. If that's the case, then falling inventory would be a bearish indicator, reflecting less buying activity in the market.
So you need to know why it's falling.
Exactly. So while lower inventory can sometimes be positive, its true meaning for VL depends entirely on discerning the underlying drivers, which means you need to look at their sales volumes versus their production figures. It requires digging a bit deeper.
Got it. Okay, so we've covered the immense potential, the impressive numbers, the operational strengths, the low-cost advantage. But as we know, especially with such high yields and a company in this kind of cyclical, capital-intensive industry, There's almost always a catch, isn't there?
Yeah.
Let's talk about the major liabilities that cast a long shadow over VLA, particularly stemming from the tragic Mariana Dam disaster back in 2015. It's really impossible to discuss VLA without acknowledging the profound human and environmental scar left by that catastrophe.
Absolutely impossible. It's central to the story.
Our sources delved deeply into the financial repercussions of this event. A recent settlement reached in Brazil for the Mariana disaster. It's requiring VLE to take on a substantial additional financial burden. They are planning to add an estimated $7.1 billion in net debt, specifically for these payments.
$7 billion.
Yeah. And to put that into perspective, this could balloon their total net debt from the current, $1.9 billion up to a staggering amount, potentially reaching about $19 billion once it's fully accounted for.
$19 billion. That's a huge jump.
It is. So what does that kind of debt load mean for their bottom line, their ability to operate? Their net interest expense, which was around $900 million in the trailing 12 months, that could jump significantly, potentially to $1.2 billion, maybe $1.5 billion annually once this new debt is fully integrated. This is a considerable and recurring increase in their financial obligations.
Indeed. And to connect this to the bigger picture, we really need to look at VLE's projected expenses against their operating income, especially for this crucial near-term period. In the trailing 12 months, their operating income was a robust $12.7 billion.
Okay, $12.7 billion operating income.
Right. However, our sources project that for 2025, their total expenses will reach an astonishing sum of around $19 billion.
$19 billion in expenses, outstripping the operating income.
Exactly. Let's break that down for you so you can really see the scale of the challenge. This $19 billion includes about $6 billion in anticipated annual dividends, assuming they maintain them, $6.5 billion in critical capital expenditures for both growth projects and just essential maintenance. Then, $3.7 billion specifically earmarked for the Mariana liabilities due in 2025 as part of that settlement.
Okay.
A projected $1.2 billion in net interest expense from the increased debt we just talked about, and another $1.6 billion in income tax.
Wow, that adds up fast.
It really does. As you can plainly see, this projected $19 billion in expenses for 2025 clearly exceeds their trailing 12-month operating income of $12.7 billion. This suggests a significant, really an undeniable cash flow crunch in the coming year.
Yeah, the math doesn't lie there.
So the critical question becomes, where will they cut back? To balance their books? Meet these obligations. Our analysis, drawing from the sources, indicates it looks highly probable, almost certain really, that dividends will have to be cut significantly in both 2025 and 2026.
Dividend cut seems likely then.
Very likely. This is because the Mariana payments are heavily weighted towards the early years of the settlement. It's designed to ensure victims, affected communities are compensated sooner rather than later, which is understandable. Now, they could theoretically reduce capital expenditures, right? But those are pretty vital for future growth, maintaining their competitive edge.
You don't want to cut CapEx too much.
Exactly. And interest and tax payments. Those are non-negotiable. So this leaves dividends as the most flexible and thus the most likely area for substantial reduction. It's a painful trade-off, no doubt, but perhaps a necessary one.
So a dividend cut seems almost inevitable given those numbers. Okay. But beyond Brazil, the Mariana shadow extends even further, doesn't it? What are the implications of the ongoing international legal cases for Vale?
Precisely. Beyond the domestic settlement in Brazil, what's truly fascinating and frankly deeply concerning is the ongoing legal exposure from the Mariana disaster in other jurisdictions. Plaintiffs are seeking a substantial $3.8 billion in the Netherlands in a separate class action lawsuit there, and an even more massive $56.5 billion in a similar court case in the UK.
$56 billion in a UK claim.
$56.5 billion. The sheer scale of these claims is just staggering. And importantly, VIA is responsible for 50% of any settlement or award that is handed down by the courts in these cases.
50%. So still potentially huge liability.
Immense. The UK court case, being further along in its proceedings and representing the larger claim, it poses what our sources term a gigantic risk, a potential $30 billion liability for Vale alone if the plaintiffs are successful.
$30 billion risk.
One analyst specifically stated that this massive, unpredictable risk makes them want to avoid investing in Vale and Lade, until at least the UK case is settled, simply due to the extreme difficulty of analyzing the likelihood, the potential magnitude, of such a gargantuan award. It's just an enormous, almost existential unknown hanging over the company. It makes traditional valuation incredibly difficult. This kind of legal uncertainty, understandably, can make many investors incredibly hesitant.
Yeah, I can see why. That's a massive variable.
Huge. And beyond the legal quagmire, we also need to consider broader operational and external risks that could significantly impact VLA. A severe worldwide recession, for example, that would severely impact commodity prices, driving down both iron ore and copper prices simultaneously,
Right.
significantly hurting VLE's revenue stream.
Right, a double whammy.
Exactly. This would make it extremely challenging for them to meet their increasing financial obligations, debt service, Mariana liabilities. Furthermore, while VLE has made considerable strides, right, there's always the legacy risk of another tailings dam collapse. It's crucial to acknowledge they have invested heavily here, approximately $5 billion since 2019, specifically to reduce this risk. Back in 2020, they identified 35 tailings dams with various risk levels. By the end of 2024, that number was down to 16 total dams still requiring decommissioning, with only one at the highest risk level. Their ambitious goal is 0 highest-risk dams by the end of 2025.
So definite progress there.
Absolutely. This commitment to risk mitigation is certainly a positive step, demonstrates a profound shift in their operational priorities. But the specter of past disasters, understandably, remains a sensitive and important factor for public perception, for investor perception.
It sounds like they're making progress on that front, which is important for confidence, definitely. But what about the bigger picture? Geopolitical factors, or even technological shifts that could impact VLE's long-term outlook?
Excellent question. We can't overlook those. Geopolitical and technological risks could significantly shape VLE's future. There's considerable political exposure, both internally from Brazilian politics, which can always impact mining regulations, taxation, operational permits, and externally, such as potential U.S. tariffs on Brazilian iron ore, for example.
U.S. tariffs, how significant is that?
Well, it's a notable fact that the U.S. imports a majority of its iron ore from Brazil, so any tariffs could significantly disrupt the market for Vale. Now, while such protectionist policies often aim to boost domestic production, establishing new mines for critical commodities locally can take ages, billions of dollars to bring online. So the immediate impact would likely be market disruption.
Okay.
Then there's the longer-term technological risk. From China. Reports indicate China is developing advanced technologies to more efficiently use lower-grade iron ore. Since VLEs primarily produces higher-grade iron ore, which commands that premium we discussed, this could potentially reduce China's long-term reliance on VLE's premium product.
Okay. Undercutting their quality advantage, maybe.
Potentially, yes. However, our sources emphasize that this technological shift, while a future concern, it would likely take many decades to scale and implement on a large enough scale to materially impact global demand for high-grade ore. So it's not an immediate threat, probably, but it's a strategic consideration for the very long term. It forces VLE to continue innovating, continue diversifying its product offerings.
Right. Always looking ahead. Okay, so that is a lot to consider. The near term certainly looks challenging. Those projected expenses, significant legal liabilities casting a long shadow. But what about the long term? Our sources indicate this company isn't just sitting still waiting for the dust to settle. They're actively planning for the future, right?
They absolutely are.
VLE has this significant strategic initiative underway called Value 2030. It centers on building what they describe as a superior portfolio. They're investing heavily, about $6.5 billion in CapEx annually. And a good chunk of that capital expenditure is strategically going into diversifying their business, particularly into copper and nickel.
The energy transition metals.
Exactly. This is incredibly significant, I think, for a few reasons. Vale is already a major producer in these areas. In fact, they rank as one of the top 1 to 3 producers for nickel globally. And copper production, as you mentioned, is set for that substantial increase, 345,000 tons in 2024 to maybe 460,000 tons by 2030. These aren't just commodities. These are absolutely crucial materials for the booming EV market, essential for battery production, foundational for the broader global energy transition. It demonstrates a forward-looking strategy, doesn't it? Anticipating future demand beyond just traditional steel production.
It really does. And what's truly fascinating here, something often observed by, seasoned contrarian investors, is how management's explicit focus on improved safety and efficiency during these tougher market times. That's often interpreted as a potential buy signal.
Oh, interesting. Why is that?
Well, it indicates a disciplined approach to cost control. A tightening of the ship, if you will, a focus on core operational excellence. These are the kinds of actions that can be highly beneficial when the commodity cycle inevitably turns upwards. It shows they are strengthening their fundamental operations, preparing for the next boon, rather than just reacting to immediate market conditions. It speaks to a long-term strategic mindset.
Right, getting lean and mean for the recovery.
Precisely. And to connect this to the broader picture of commodity cycles, history provides a powerful lesson, right? Periods of booming prices are almost invariably followed by a few years of ugliness. Where prices consolidate or decline, market sentiment sours. The current environment, with its lower iron ore prices, global economic uncertainties, Vale's significant legal liabilities, this might very well be that ugly period. But for investors with a genuine medium to long-term mindset, say a 3 to 4 year horizon, this can be the perfect setup. The key, however, is immense patience and being prepared to potentially average down your position if the stock drops further, maybe to that 6 to 7 per share range, as some of our sources suggest might happen in a tougher scenario.
Yeah.
This requires strong conviction, in the inevitability of the long-term commodity cycle turning. It's about seeing beyond the immediate pain to the future potential.
That's a great perspective on cycles, patience, and conviction. Let's dig deeper into what this patience could actually yield. Can you walk us through some illustrative valuation scenarios from our sources, show the potential upside and downside for a long-term investor?
Absolutely. Let's consider some illustrative valuation scenarios derived from our sources, just to understand the range of potential outcomes for you. In a bad environment scenario, right, where iron ore prices drop even further, maybe into the lower $70 per ton, coupled with slightly higher capex, those significant lawsuit expenses, VAL might realistically earn only about $2.5 billion per year.
Okay, $2.5 billion profit in a bad case.
Right. At a conservative valuation multiple, this could lead to a hypothetical stock price of around $4.69, meaning potentially about a 50% crash from current levels.
Ooh, 50% down.
Yeah. However, it's critical to note, even in this severe scenario, the company would likely remain cash flow positive, capable of covering its interest payments, potentially very small symbolic dividend. It's a downturn, yes, but not necessarily a catastrophic collapse for the underlying business itself.
Okay, so survivable but painful.
Exactly. Now let's look at an average environment scenario. In this case, iron ore prices hover around more typical historical levels, maybe in the 90s to low $100 per ton range. In this scenario, VLA could probably generate around $5 billion in annual profit, even accounting for higher capex and current Mariana expenses. In this more stable environment, the stock could trade around its current levels, $8, $9 per share, something like that. And critically, the company might still be able to pay a respectable, say, 6–10% dividend, depending on capital allocation, debt management.
So kind of treading water around current levels.
Pretty much. A more stable, medium-term outlook. Operates profitably, but without those extraordinary boom-time returns. But here's the big upside scenario. The one that truly excites long-term, contrarian investors. In a good scenario, right? With a robust recovery in China's property sector, stronger global economic growth, perhaps a general uptick in demand for industrial commodities.
Okay, the boom times return.
Exactly. In this environment, VA could realistically generate a significant $12 billion in annual profit. Our sources suggest this kind of profitability could push the stock price to over $19 per share.
Over $19, more than double from here.
Representing a more than 2x return from current levels, potentially. And potentially allowing for incredibly high dividends, 20% or even more. The advice from the experts we looked at is clear. Ideally, you want to acquire shares closer to that bad environment scenario to maximize the multi-bagger upside when the cycle eventually turns, because that's when the most dramatic gains are realized. It's a game of patience and timing.
Buy low, sell high. The classic cyclical play.
Essentially, yes, but with significant complexity here.
That's a powerful range of outcomes. Really highlights the cyclical nature, doesn't it? And it brings us back to something you mentioned earlier about how traditional metrics can be misleading for companies like VL. What should investors focus on instead, if not PE and yield?
That's a critical point for you to consider, absolutely.
Yeah.
For highly cyclical companies like VL, traditional valuation metrics, PE ratios, current dividend yields, while initially attractive, they can be incredibly misleading. As one expert starkly noted, they mean nothing if iron ore prices crash and profits or dividends disappear entirely in a downturn.
Right, they vanish when you need them most.
Exactly. These numbers are just a snapshot in time, not a guarantee in such a dynamic industry. Instead, investors should probably focus on a deeper understanding of the underlying commodity cycle itself. Where are we in the cycle? What are the long-term supply and demand dynamics? For iron ore, copper, nickel. How strong is the company's balance sheet? Its cash flow generation through the cycle, not just at the peak. What's the cost curve of the industry? Where does VALE sit on it? We know they're low cost. That's key. It's all about understanding the resilience of the underlying business through volatility, rather than getting fixated on a single, potentially ephemeral metric like today's dividend yield.
Resilience through the cycle. That's the key takeaway. So, what does this all mean for you, our listener? We've taken a truly deep dive into Vale. We've uncovered a company with immense long-term potential, driven by its dominant position in iron ore, yes, but also its growing strategic diversification into critical energy transition metals like copper and nickel. This strategic shift into commodities essential for global electrification. That's certainly a long-term positive, isn't it? Aligning them with some of the biggest trends shaping our future.
It seems like a smart long-term hedge.
But we've also squarely faced the significant challenges: the enduring shadow of the Mariana disaster, the huge potential legal liabilities from ongoing international lawsuits, and of course, the inherent volatility of commodity markets that directly dictate its profitability.
Big headwinds.
Big headwinds indeed. That initial incredibly attractive dividend yield of nearly 15%. It comes with the very real near-term burden of massive settlement payments, significant capital expenditures, which, as we've discussed, are highly likely to impact future payouts, probably in 2025, 2026. It's a classic high-reward, high-risk situation, demands a keen eye on global economic trends, an understanding of commodity cycles, and, frankly, a tolerance for significant swings in both the company's performance and its stock price. It's definitely not for the faint of heart. But for those who understand the cyclical game, the potential could be extraordinary.
Absolutely. Ultimately, Vale stands as a fundamentally strong, highly profitable company. It's absolutely essential to global industry, providing the core materials for urbanization, infrastructure development, and now increasingly for the energy transition. Its long-term performance hinges not just on the fluctuating price of iron ore, though that's huge, but also critically on its ability to successfully navigate these complex legal and environmental challenges, and the broader global economic landscape, particularly the health of the Chinese economy.
So much depends on navigating those challenges.
It does, which raises an important final question for you to consider. Given Vale's strategic importance, right, in supplying the core materials for global urbanization, and, crucially, the accelerating energy transition through copper and nickel, how might the increasing geopolitical focus on securing critical mineral supply chains and the long-term, frankly undeniable demand for electrification, how might those powerful long-term forces ultimately override the short-term cyclical downturns and these significant legal risks, shaping Vale's destiny and its value proposition for decades to come?